This is the Norris Group's Real Estate Investor Radio Show, the award-winning show dedicated to thought leaders shaping the real estate industry and local experts revealing their insider tips to succeed in an ever-changing real estate market. Hosted by author, investor, and hard money lender, Bruce Norris.
Hi, thanks for joining us. My name is Bruce Norris, and I'm with Joey Romero. And our guests today are really two friends. Having helped thousands of investors across the U.S. to save on taxes, MacFarland and Amanda Han are founders of Keystone CPA. As both tax strategists and real estate investors, Matt and Amanda combine their passion of real estate investing with their expertise in tax strategies. Their goal is to help investors with strategies designed to supercharge their wealth building using entity structuring, self-directed investing, and income offset opportunities to keep more of what they make. Amanda and Matt's highly rated book, Tax Strategies for the Savvy Real Estate Investor, is amongst Amazon's top seller list. They speak and have written in many of top publications. They have experience in working with the big four tax companies, and they're just really great people. So Matt and Amanda, welcome to our show.
Thank you for having us. Excited to be back.
Yeah, thanks, Bruce. Appreciate it.
I thought I would open this because it's interesting that we get in my head, it sort of like comes out as a different narrative, but 38.5% of taxes, US taxes collected, are paid by the top 1% of earners. 70.1% of all taxes collected are paid by the top 10% of earners, meaning that 29.9% of federal taxes that were paid by the bottom 90% of taxpayers. So the top 1% paid 38.5, the bottom 90 paid 29.1. And why do I bring this up? Because if you're going to chase tax revenue, you have to take it from the top 10% and maybe especially the top 1%. So having said that, I'm just curious, Matt and Amanda, what's the general mood of your clients who have accumulated some wealth?
Oh gosh. Well, I think most of our clients are very proactive, when it comes to tax planning, and
Sure.
The reason why most people hire to work with us. But yeah, it's definitely on a more elevated or heightened level whereas before I think a lot of clients would more passively wait for us to tell them when there are tax changes. And now we're getting, more frequently we're getting clients who are following the media, following the news, and then contacting us to say, hey, I read about this or I heard about that. So certainly a lot more awareness in what is coming up, in terms of proposals and things like that. In the past, people would say, oh, well, this is past, right? This is a tax change that's past. We work on the strategies, talk to the clients about it. This is kind of where we're talking about strategies before anything are even passed.
Right.
I think part of the mood is there's a lot of deficits, right? It's you got to pay for it somehow, right? So I think the general consensus, obviously, the taxes are going to go up, and it's a question of how much and when, right? Like that seems to be what we're seeing.
Okay. Well, would you say the majority of your clients are real estate heavy or stock heavy, or really a combination?
That's a good question. I mean, all of our clients are fairly real estate heavy. So not everybody has a huge portfolio, but all of our clients have a focus in real estate in some form or fashion. We do have also a lot of clients that are in the tech industry who are stock heavy, because that's their employer or they have a startup. Right. But yes, almost all of our clients are somewhat heavily involved in the real estate side, or at least plan to be heavily involved in real estate.
What's interesting is I'm not sure most people know, but you have a bird's eye view of the mood of America when you do a season of taxes, because you're sitting across from people that are either pretty euphoric or pretty devastated. So you may have a very interesting blend this year. You've got people that own assets that are, pretty dang excited about what happened to their stock portfolio after, say, March and April, and their real estate prices. But you also may have tax preparing going on for a small business person that doesn't own a thing other than that business.
Yeah.
Yeah, it'll be one of the things when we prepare taxes in our software, they've got a little one-page thing that compares, this year to last year. So it'll be interesting. That's one of the things I always look at as I'm kind of doing my last high level review of a return is like, what are the big changes from year to year? And so I think that'll be really interesting to see, kind of see the drastic changes and then dive down and see, okay, what was it revenue? Was it expenses? All kinds of things like that. I think it'll be interesting.
Yeah, and I think something so interesting this year is, Matt and I we attended several continuing education classes for CPAs last week. So we attended one that talked about the projected or the proposed tax changes for 2021 and beyond, which is, talking about mostly tax increases. And then we also took another 2-day course about the 2020 CARES Act changes, which was, a lot of the credits and the benefits and the bonus depreciation. So I think it's a huge swing in the tax world in terms of what transpired in 2020 versus what is potentially coming down the pipeline. So yeah, huge swing in mood for sure.
Yeah. Well, let's talk about, we're about to do our 2020 taxes. So what were some of the changes that are, already in place that when you do your taxes in 2020, what's different in 2020 and might not be there in 2021, or go ahead.
No, I was going to say, one of the things that comes to mind right away is, especially given how 2020 could be a significantly different year for a lot of people in terms of income or having a bad year, depending on their industry, is that with the 2020 year, if somebody generates a net operating loss on their tax return, and the easiest way to think about that is if somebody has, negative taxable income on their personal return, they're generally going to have what's called a net operating loss. And the IRS is giving people the ability to take that 2020 loss and either carry it backwards 5 years to 2015 or carry it forward to 2021. And the taxpayers can make their choice depending on how their income was 5 years ago versus what they think it's going to be next year. That goes away starting with 2021 returns. So in 2021, if somebody has that exact same loss, unless they change the law again, they're not going to be able to carry that 2021 loss backwards. They'd have to carry it forward. So that'll be something I think people will be keep an eye on and take advantage of, and work with their CPA to kind of figure out that analysis. That
should leave a pretty big hole for tax revenue for 2020.
It's interesting because, I think a lot of people would think, well, obviously, if I had a bad year and I needed the cash right now, I would go back and get a refund immediately, right? But I think one of the planning points that we are talking to clients about is, the concept of maybe filing extensions. We have clients who just always are on extensions, and we have ones who are very anti-extension. But that might be a reason to consider extending this year because, what if tax rates do increase starting in 2021? It might make more sense to use those 2020 losses to offset 2021 income.
Oh, I see.
Yeah, if you were a 30% tax bracket in 2015, and then now all of a sudden you're in 39.6% in 2021, you're going to save a lot more money in your pocket. But who knows if by April 15th we'll have the answer to what our tax rate is going to be. And if we don't, then it might make sense to file extensions just so we have, more hindsight into what exactly is going to happen in the future.
Yeah, Amanda, that's a really good point.
Is there any talk about, in 2020, since we're talking specifically about that, any of the rules that came across based on the pandemic and COVID? How is that? Because if there's one thing that we know about real estate investors, they're creative, so they try to find solutions. And is there any strategies that you've heard of or anything that they could take advantage because of the things that came down through COVID?
Yeah, certainly. Well, even just the one that Matt was talking about, right? The net operating loss, that's a part of the CARES Act under COVID. So from a planning perspective for real estate investors, when we talk about depreciation, cost segregation, where we can basically, push forward all of our future write-offs, that's a huge planning point that we're going to be looking at whether to implement when we file the 2020 tax return. Because if so, if someone who has a portfolio of properties, if you can create a $200,000, $300,000, $400,000 depreciation, that's a paper loss. Well, now all of a sudden we have a huge benefit and we can maybe get an immediate refund, right? So yeah, certainly there's a lot of planning that are available for a real estate professional. I mean, the strategies are not new, cost segregation, depreciation, bonus depreciation. Those are all things that, we kind of have used in years past. But this will be an interesting year to see whether or not we want to do it, because CARES Act allows us to do it. But it's a choice of, is it the right time to do it, assuming taxes will increase in the future.
Cost segregation, just briefly talk about that. And then I want to ask about if you have to at some point recapture, you sell something and you don't 1031 exchange it, what's the tax bill for that?
Right. So cost segregation just deals with depreciation on people's rental properties, commercial, residential, doesn't matter. But essentially, with rentals, as you guys know, obviously everyone gets a standard calculation of depreciation expense every year, where you're writing off a percentage of your purchase price of the building every year. With a cost segregation, all it does is going in and looking at the building and trying to figure out ways to break out components of that building that should be written off over a shorter period of life or over a quicker time period than 27 and a half years or 39 years. So essentially all cost segregation is doing is bringing more depreciation to the forefront so you can take it sooner than later. You get the same amount of depreciation over the life of the asset. It's just how do we take more of it sooner than later so that we can get our write-offs now, save our taxes now, reinvest that into, better, more performing assets, all that kind of good stuff.
And if I did sell it and I had to pay the tax bill, what's the recapture tax on that?
Yeah, if you do sell it and you don't do an exchange, there is recapture tax. It can be 25%. It can be ordinary income. Kind of depends on what the items are that were sold and depreciated, and But there's also strategies on the back end when you sell things and kind of maybe reallocate the sales price to some of the more of the sale price of the building and less to the personal property, so you've got less to recapture. There's different things people can do.
Yeah.
Okay. Just a couple other questions in 2020. I know the rule was passed a while ago. Standard deductions got raised. They're still in place. So what's the standard deduction, let's say, for a married couple? And they also limit your ability to write off the state tax and the whatever else, what is state tax and
property taxes?
State tax and property taxes.
Yeah. So standard deduction for 2020 is around, I don't have the exact figure, but it's around 25 grand for a married couple.
Right.
They changed it a couple years ago. More people are using it, at least in our firm, more people are using it than they were in the past, but it's still I think for our clients, probably a majority of people are still itemizing just based on the numbers. Maybe 20% of our clients use the standard deduction.
Okay.
But again, if you have more than 25,000 of itemized deductions, you're going to end up using that than your standard deduction.
Yeah, I think that means for people who live in California, that own a home, mortgage interest is still, that's still a fairly large expense. People who are making donations, that's still fairly large write-off. So that's why we still see a big chunk of people that are still itemizing. But certainly one of the biggest tax changes that came out, in 2018 under the Tax Cuts and Jobs Act was this $10,000 limitation on primary home property tax and, estate income tax. So that's a huge limitation that really impacted a lot of taxpayers, especially for states like California.
Absolutely.
Yeah. So I think looking ahead, 2021, there are signs that might be reversed, where we are now again able to take tax deductions without limitation for property taxes and state income tax. But we'll see, right? That's one of those potentially good news that if it were to be passed.
On a year that has maybe not very many, that's the good news. All right, I'm just going to go down like a list, and I know nothing's been decided on these, but give us your take on when you go to these meetings, what's the mood about, and what's it likely to go to? So current top tax rate for personal taxes is?
Right now it's 37%.
And you think, or what is being discussed now about it might change to what?
So the talk that the Biden administration kind of was throwing out there during the election and everything is that they're planning to push it up to 39.6%. And that would be for people, making over $400,000 as a married couple. So that would be a big change from where it currently is, because at $400,000, you're probably only paying, top end of the 32% bracket, maybe getting into 35% right now.
Right.
So it would be a big change for those people on the higher end of $400,000.
Okay. Current top corporate tax rate?
So a couple years ago, they changed it to a flat rate of 21%. There's talk that they want to increase that from a flat 21 to a flat 28%.
That's like 30+%.
Oh, yeah, no, I mean, and 5 years ago or whatever, it was, there was a graduated scale where the lowest one was 15%, or,
Yeah.
other than 0%, obviously. But I mean, so yeah, it'll be interesting to see if that goes through.
The current capital gains tax rate?
So it's a kind of a graduated scale for the capital gains rate. Most people pay 15%. Some people pay 20% if their income is above, around $430,000 for a married couple. They're going to pay 20% on, some or, all of their capital gains. But the proposal, if I remember correctly, the proposal they're talking about is increasing the rate on capital gains to 39.6% for people making over $1 million.
Right.
Now, my understanding of that is $1 million of taxable income, but is that where it finally falls out? Is it taxable income? Is it gross income? Is it AGI? I mean, who knows?
Yeah, because you could sell an apartment building and have $1 million.
Yeah, exactly. I mean, it's not hard depending on your portfolio, obviously.
Okay. Collecting Social Security tax on earners that make over 400 grand. That's something that they're talking about.
Yeah, so that's one where, right now everybody's Social Security tax, kind of their wage base, if you will, caps out at, I think the 2021 number is around 142,800, something like that.
Yeah.
If this goes through, they want to bring it back once somebody's income reaches $400,000. Now, this would be wages because this is what it's applied on. So basically, if somebody makes $500,000 of wages, they'd have Social Security tax on the first, 142, and then the last 100,000 over above 400, they'd have the amount in the middle that we call like a donut hole. They wouldn't have any Social Security tax on. That's what I'm reading, at least.
Yeah, I think you're right. But that's not a little tax. What's the
no?
percentage?
I mean, that's the thing. I mean, you got clients that have RSU stock options. They exercise them, and their W-2 goes up by $1 million because of the stock they received. I mean, that would count towards that tax.
Okay. Now, the way Social Security tax is paid, it's typically split by an employer.
Yeah, for sure. I mean, yeah. So that they would, the employer pays half of it, the employee pays half of it. But for those people who are self-employed,
Yeah. I think the pros and cons, we have a lot of clients who are self-employed. So if they have their own S Corp or C Corporation, the downside to that is you are the employer and the employee. So
yeah,
theoretically, all 15% is still coming from your pocket. The good side of it, though, is that there's a lot more planning opportunities. We can say, well, let's reduce our payroll to stay under the threshold and take out more as dividends or more in terms of, write-offs. So there's more strategies there versus, a true employee. Obviously, you're not going to tell your employer to reduce your compensation to save on taxes, right?
No.
Joey, you want to reduce your compensation?
Yeah, I have a meeting with Bruce right after this about that.
Trying to save on Social Security taxes.
No, Medicare, is that always being charged on every dollar at this point?
Yeah. So right now the Medicare tax is taxed on every dollar of earned income. So haven't heard anything that's going to change.
That's a small piece of it. That's
only 1% or something like that. Okay.
Yeah.
So when they make tax law changes, well, I guess since none of it's in place already, do you think the tax law changes will be implemented in 2022?
Yes. I mean, if there's going to be changes, we feel that the natural place to do it would be starting in 2022, just because there's a lot, other pending, other more urgent things that maybe the government's working on in terms of COVID-19, unemployment, stabilizing the economy and things like that. But, it's anyone's guess. I mean, in the past, there has been retroactive tax changes as well, where something passes in 2021 could be retroactive to the 2020 year, right? I mean, it's highly, highly unlikely, but, if we look at it historically, those are things that has occurred. And also there is a possibility that some of these changes, with respect to rates and things like that, be applied retroactive to January 2021. That's more likely than going all the way to 2020. So yeah, some possibility of 2021 changes, but hopefully 2022 and beyond.
Or maybe they're staggered in. They pick a few of them. I don't know. I think if you look back at the kind of the first year of past administrations, the tax law changes isn't usually one of the biggest items on the table, if I remember correctly. But it's kind of it's a guessing game, obviously, to some extent.
The retroactive tax, that's I sent you, I guess Joey sent you some questions that I came up with, and that one is kind of interesting because I spent the morning reading, and one of the things I kind of came up on some interesting tax proposals that's coming up for a vote in August in California. And this is where you're going to, if you're making over $5 million in income, that your state tax will go to 16.8%, and it will be retroactive for the entire year.
Yeah.
And go ahead.
I was going to say things like state tax rates. It's either going to be go forward or retroactive, because you can't really have a mid-year change, right? We can't say income earned after September 1st is a new rate. So yeah, things like that are usually.
I mean, they could if they really want to complicate things.
but yeah, things like rates are usually, for the year. But other things like maybe a 1031 exchange, more transactional ones. Usually, typically we see those as of a specific date.
Well, what's interesting about that picture is I'm not sure. Now it says it gets voted on in August. I'm not sure who gets to vote on that. If it's the state of California, I think it has to do with the legislators. So I'm painting something, and this is like when I opened the conversation with you guys, I went down and said, what percentage of taxes were paid by top 1%? In California, 40% of the income tax is paid by the top 0.5%.
Wow.
Oh, yeah.
40%. Now, if what we're kind of contemplating, let's say you're one of the $5 million guys who's paying 40% of this stuff. You now have the chance to have a tax rate of 39% plus a state tax of 16.3 plus a social security tax of what, 7.5?
Mm-hmm.
Yeah. Or, and then you got net investment income tax of another 3.8%. If you've got a lot of net investment income, I mean, yeah, it's.
Yeah, you're at 62 to 65%.
That's an opportunity right there.
Yeah, you're going to need to talk to some billionaires, buddy. You're going to raise the average net worth of your clientele pretty quick.
Yeah, I'll share something really interesting. We sign up for a lot of, CPA classes ourselves, like I was saying. And there was one earlier this year that was about relocating out of California. How do individuals do it? How do businesses own it? That class was sold out almost immediately. When it was released. And Matt and I talked too, we talk to clients on a weekly basis. And, every week there's got to be a handful of people who are either have already moved out of state or are in the process or looking to move out of state. So yeah, certainly, like you're asking, what is the mood? The mood is that, that we all need to be looking ahead proactively. In what's coming down the pipeline.
Yeah, one of the things interesting on that California tax increase, and I think California is also contemplating like a wealth tax of
that was my next question.
0.4% or something, right? One of the trainings we listened to or attended last week, they were saying, these were on the table last year, and they put them on hold. But the caveat at the end was, don't get too excited that it's gone away. That it basically is just being delayed, like as you said, probably till you found the August date, right? That they're contemplating, re-voting or whatever you want to call it on these things. So yeah, it was on the table last year. They kind of put on a hold for whatever reason, right? But yeah, I think it's coming down the pipeline and they want to rediscuss it. But yeah, I mean, that's crazy. That's like you said, 60-65% if you're making over those top levels that you'd be giving away to the government. I mean, it's
just contemplating when you think about net revenue We'll talk about that in a minute.
What did our friend Harry call it when we had our event in November? He called it confiscation, I think was his word.
Yeah, he wasn't a happy camper. That's right. I don't think we get to vote on that stuff. That's one of the things that I wanted to ask, but I think we both don't know for sure, but I don't recall getting to vote on my tax rate. So I think that's a congressional vote.
Yeah, probably.
And it's usually dominated by, if you're going to reduce it, there's no Democrats that vote for it and almost all the Republicans. And if you're going to raise it, it's probably just the opposite. So the odds of it getting a higher tax rate coming our way, if that's the way the vote goes, is probably pretty likely. Here's a list of taxes or changes tax code that were being talked about. One of them was wealth tax. Now, when the state of California dreamed that one up, I had a pause moment and go, wow, I didn't even know a state could contemplate that. I had thought maybe that would come from the US, but I had no idea the state could dream it up, and maybe even simultaneously.
Mhm.
Yeah, it is interesting because you're right. I mean, you think of it naturally as coming from like the top down, right? Like, the states are gonna base their decisions. The federal is a starting point, right? And then we either agree or disagree with that, but not necessarily that they can come up with their own thing, right? I mean,
I think California is notorious for having our own set of rules with respect to, almost everything. And so for us, we have to take trainings from the tax filing side specifically for California. Real estate, for example, at the federal level, there's a loophole for real estate professional where, regardless of how much money you make, if real estate is sort of your full-time gig, then you might be a real estate professional and use the losses to offset other income. California has never recognized that. Yeah. And it's a shock to a lot of clients because, they just don't understand why. Or even, bonus depreciation. We could write off 100% of assets for the IRS, and California says, no, can't do that. So there's all these things. I mean, it's gotten sort of crazy where we're doing two completely different returns, almost like for two different countries, if you will.
Yeah, well, capital gains is like that, right? You have a capital gains tax that's less than the individual, but in the state, it's just the same thing, right? It's an individual number.
Yeah.
Right.
Yeah. California doesn't have a lower tax rate for capital gains.
This was floated in front of me and I thought, wow, that's an interesting one. Taking stock gains without having to declare stock gains without actually selling the stock, just the fact that it went up. Is that being contemplated?
Yeah. I mean, they didn't talk a lot about that in the trainings we've attended, but yes, that's something that has been discussed in the past. So yeah, that is kind of a scary road to go down because I think, again, just looking at some of our clients, like that are in the tech space, those stocks are very valuable. So it kind of forces you to sell, right? Forces you to sell the stocks just to pay the taxes on it. Hopefully, that doesn't come to fruition, but what if that starts to apply to real estate where you have a revaluation, let's start paying gains on real estate appreciation before we sell.
Let's get in the appraisal business because every asset would have to be, in real estate, how would you determine if it went up? You'd have to have an appraisal.
Yeah. I regret even saying that because I don't want anyone to get any ideas for that. So Joey, let's edit that out.
Well, no, I was about to ask you about Bitcoin. What kind of news is coming that way?
Yeah, well, that's actually one of those that's probably taxed more in the line with what Bruce was discussing, that things just change in value, that you get taxed. So, I don't claim to be a Bitcoin expert by any stretch of the imagination, but
I don't think anybody is.
There's like 5 or 6 questions we have to ask clients about that. Like, did you mine it? Did you exchange it for some other coin? Did you do this or that?
There's a new term called airdrop or something. Does he pay taxes when it's airdropped? I'm not sure. But yeah, similar thing. They're usually treated like the stocks. So currently it's if you sell it.
If you use it like that, but if you use it as like monetary, to buy something, like buy something from the store, I don't know, you can get taxed on the change in value. It's crazy.
Oh yeah, of course. I never thought about that. Yeah,
that's the only reason I ask is the roller coaster. It's been, in the morning, it could be $10,000 different at the end of the day.
So one interesting takeaway is that I learned from this thing that our 9-year-old son was excited to find out was that the V-Bucks and Roblox you get from these virtual online gaming games are not considered virtual currency. So he does not have to report that anytime he plays it.
Nice. Sorry, I didn't mean to sidetrack us there.
That's okay. 1031 exchange rules. Do you think they're going to be touched?
Well, the 1031 exchange rules were touched back in 2018. It's just not something that we talk about a lot. So under the tax cut, so before the Tax Cuts and Jobs Act, you can use a 1031 exchange to defer other assets and not just real estate. So certain business assets, if you sold it, you can defer it. Common example is a car. You have a business car, you sell it, you buy another business car, you can do a 1031 exchange. But starting in 2018 under the Tax Cuts and Jobs Act, they took that away. So since then, 1031 exchange was only available for real estate investment properties. But yes, there are, talks floating around of potential changes. And, I feel like it's highly possible that there are some changes to it. What exactly are the changes? We don't really know yet.
But yeah, that's the interesting because I don't think that one was as specific during kind of the run up to the election and all their discussions and the proposals as was a specific 39.6% highest tax rate or changing capital gains. And so those were very specific things they talked about. The 1031, I think it's out there, but it was, so for whatever that's worth, if it wasn't as specific,
Yeah, we didn't know if that meant it was going to be limited or not allowed for people making over 400,000, or if that's just going to be gone, permanently. But obviously our hope is that stays. Because I think you can imagine if they take away 1031 exchange, they increase the capital gains tax rate, they take away the step-up basis, then that's, a whole slew of major tax changes that will impact real estate investors. If we sell, we can't defer the tax, and then we have to pay it at 39%.
Yeah, but it kind of raises the next obvious question. So would it impact those types of assets ever being sold again? Heck yeah.
Yeah. And I think the timing is important too, right? If they come out and said, as of today, as of February 1st, there's not going to be any 1031 exchange, then I agree with you, probably no, a significant decrease in movement. But if they said, effective 2022, there won't be 1031 exchange and the capital gains will go up.
And it'll go up if you don't sell an asset. I mean, we can go,
And so I think
fire sale.
You'll see a very significant number of transactions where people are really analyzing their portfolios and saying, where do I see myself in the long run, and get rid of all the other ones before the end of the year.
I think if that happens, you're going to see Bruce's flight from California to Florida continue on to like Switzerland and the Grand Cayman Islands or something like.
No.
And that's going to do it for part one of our interview with Matt MacFarland and Amanda Han of Keystone CPA. Tune in next week for part two. Thank you.
For more information on hard money loans and upcoming events with the Norris Group, check out thenorrisgroup.com. For information on passive investing with trust deeds, visit tngtrustdeeds.com.
The Norris Group originates and services loans in California and Florida under California DRE License 012-19911, Florida Mortgage Lender License 1577, and NMLS License 1623669. For more information on hard money lending, go to thenorrisgroup.com and click the Hard Money tab.